Imagine stepping outside on an ordinary afternoon, opening your mailbox, sorting through grocery flyers and electric bills, and then noticing an official envelope from the IRS. Your chest tightens slightly. You assume it's probably something routine. But when you open it, you're staring at a penalty for $10,000. And the worst part is you have no clue what you did wrong. You didn't stash money overseas. You didn't operate some hidden business. You didn't falsify your taxes. All you did was deposit cash from selling your pickup. Or maybe your daughter sent you money to help cover hospital bills. Maybe you shifted funds around so you could finally replace that aging roof. Completely normal retirement activity. Yet in 2026, normal doesn't automatically mean protected. Because what's triggering these penalties isn't criminal intent, it's patterns. Patterns detected by automated systems that don't understand your personal story. And once that system decides something looks off, penalties can begin at $10,000 for a single violation. Today, we're breaking down what's really happening, why so many retirees are being blindsided, and the simple mistake that can turn an innocent trip to the bank into a federal issue. I'm Sophia, and I spend my time helping retirees safeguard the nest egg they worked decades to build. And there's something that has quietly shifted in the financial landscape this year. The rule itself isn't new. It has existed for decades. What's changed in 2026 is how it's enforced, faster, automated, and far less forgiving when details don't match perfectly. My purpose isn't to frighten you. It's to make sure you understand what's going on, which everyday banking activities can trigger serious penalties, and most importantly, how to protect yourself from ever experiencing that $10,000 shock. Because once you see how this works, you'll realize the risk isn't obvious. And that's exactly why this conversation matters. Let's begin with what's catching people completely off guard. Everyday transactions that look harmless on the surface. Imagine selling your old truck for $15,000 in cash. The buyer pays you, you head to the bank, and you deposit it. Straightforward. Or your son wires you $20,000 to help with unexpected medical costs, or you finally accept that lump sum pension payout you've considered for years, or you transfer a substantial amount of savings to put a down payment on an RV. None of that is illegal. None of it is suspicious. It's simply life. It's retirement. It's your money. But here's what's different in 2026. Banks don't just hold deposits. Certain activities are automatically reported. And those reports aren't sitting in dusty filing cabinets. They're scanned, sorted, and cross-referenced by systems built to detect inconsistencies. So when a large amount of cash appears in your account, the system doesn't see truck sale or family gift or pension distribution. It sees data. It sees movement. And if that data doesn't align with your tax filings or financial records, it raises a digital red flag. From your perspective, you're just handling your finances responsibly. From the system's perspective, it's asking one question. Where did this money originate, and was it properly reported? If the answer isn't clearly reflected in the data it can access, that's when complications begin. What surprises most retirees is that the rule behind this has been around for decades. The difference now is how aggressively and efficiently it's applied. At the center of it is something called a Currency Transaction Report, or CTR. Despite the intimidating name, it's simple. Banks are required by law to file a CTR whenever someone conducts a cash transaction over $10,000. That includes deposits, withdrawals, and certain transfers. If you deposit $12,000 in cash, the bank fills out a report and submits it. You don't complete the form. You might not even know it happened. It's automatic. A CTR is not a penalty. It's not an accusation. It doesn't mean you did anything wrong. Millions are filed every year. For decades, this has been routine. Business owners deposit revenue. Individuals sell vehicles. Families shift funds. The bank files the report, and life moves forward. So why are retirees suddenly hearing about $10,000 penalties? Because in the past, these reports typically sat idle unless a human investigator had a reason to dig deeper. Today, they are instantly processed through automated systems that compare them with tax returns, Social Security income, pension distributions, and other financial records. The system isn't just collecting information. It's analyzing it in real time. And when something doesn't line up, that's when problems can surface. There's another layer that's even more dangerous than making a large deposit. It's a mistake well-intentioned people make all the time, thinking they're being cautious. In the eyes of the IRS, that single decision can transform a completely legal transaction into a federal violation. Here's how. Suppose you have $12,000 in cash. Maybe it came from selling a boat. Maybe it's savings you kept at home. As you walk into the bank, a thought crosses your mind. If I deposit this all at once, it will be reported. I'd rather avoid extra attention. So instead, you deposit $8,000 on Monday and return Wednesday to deposit the remaining $4,000. From your point of view, that feels harmless. You're not hiding income. You're not evading taxes. You just don't want paperwork filed. Seems reasonable. Under federal law, however, that decision can change everything. It's called structuring. Structuring occurs when someone deliberately breaks up a large cash transaction into smaller amounts to avoid the $10,000 reporting requirement. Here's the part that shocks people. The money doesn't have to be illegal. It doesn't matter if it came from a pension, a personal sale, or a family gift. If deposits are intentionally split to avoid triggering a CTR, that action alone can qualify as a violation, and penalties for structuring can start at $10,000 per occurrence. The contrast is critical. Deposit $12,000 in one transaction, the bank files a CTR, and in most cases, nothing further happens. It's legal and routine. But split it into $8,000 and $4,000 specifically to avoid reporting, and you've created a pattern automated systems are trained to detect. These systems analyze timing, amounts, and sequences across days or weeks. If activity appears structured to stay under the threshold, alerts escalate quickly. The system doesn't know your intentions. It doesn't recognize that you were simply trying to avoid attention. It sees the pattern. And the pattern is what counts. This is where good people get into trouble. They believe they're being careful, staying under the radar. In reality, breaking up deposits to avoid reporting is precisely what places them on the radar. Filing a CTR is not the problem. Attempting to avoid one can be. And in 2026, with advanced automation and real-time analytics, these patterns aren't slipping through unnoticed. The system doesn't require a human analyst to flag inconsistencies. It does it instantly, connecting deposits to tax filings and reported income. When discrepancies appear, notices can be generated automatically. Before anxiety sets in, take a breath. The IRS isn't targeting retirees who manage normal finances. The vast majority of individuals who deposit money properly, even large sums, never face issues. The real risk lies in misunderstanding the rule. So here's the key takeaway. Never split a transaction just to remain under $10,000. If you possess more than $10,000 in legitimate cash, deposit it in one transaction. Allow the bank to file the report. That's expected. That keeps everything clean. Now let's shift from awareness to protection. This isn't about fear. It's about preparation. Enforcement in 2026 may be faster and more automated, but protecting yourself is surprisingly straightforward. It doesn't require complex loopholes. It requires documentation, consistency, and transparency. First, document everything. Whenever a large amount of money moves in or out of your accounts, keep clear records showing its source. Sell a car for $15,000. Keep a signed bill of sale and store a copy. Receive a $20,000 gift? Ask for a simple gift letter stating the amount and confirming it's not income or a loan. Take a lump sum pension? Retain the distribution paperwork. Withdraw funds for a major purchase? Keep invoices and receipts. If questions ever arise, you can immediately demonstrate the origin and purpose of the funds. Remember, the IRS computer doesn't understand context. It sees numbers. Your documentation tells the story behind those numbers. When that story is organized and supported, issues are usually resolved quickly. Second, if your financial situation is more complex than basic Social Security and a small pension, meet with a qualified tax professional. A strong CPA ensures your tax return reflects a complete and consistent narrative. Large deposits from property sales should align with reported information. Significant gifts should be properly documented. Automation flags mismatches. Professionals help prevent them. Third, communicate openly with your bank. There's nothing wrong with asking about reporting policies. Transparency works in your favor. If you plan to deposit a large amount of legitimate cash, do so properly and let the required report be filed. A CTR is routine. Avoiding it creates risk. When you combine documentation, professional guidance when needed, and transparency, you drastically reduce the chance of ever facing that $10,000 penalty. Yes, automated systems in 2026 are powerful. They connect data instantly and cross-reference filings. But they are data-driven. They depend on consistency. When your records are organized and transactions straightforward, you're operating exactly as expected. This isn't about secrecy. It's about clarity. The financial world has evolved. The old belief that small inconsistencies would go unnoticed is fading. We now live in a digital enforcement era. Those who adapt early avoid unnecessary stress. The larger picture is this. Automation in financial oversight isn't temporary. It's embedded into how the system functions. The retirees most at risk aren't criminals. They're individuals relying on outdated assumptions. Years ago, staying quiet felt cautious. Today, attempts to stay under the radar create the very signal systems detect. One properly documented $15,000 deposit is routine. Multiple intentionally split deposits are not. The system isn't emotional, but it assumes patterns designed to avoid reporting deserve scrutiny. Once scrutiny begins, resolving it can be stressful and costly. Most retirees will never face a structuring penalty. Most properly handled deposits move through without incident. The purpose here isn't to make you fearful of banking. It's to replace uncertainty with understanding. When you recognize that a CTR is normal, you stop fearing it. When you understand structuring involves intent to avoid reporting, you stop creating risky patterns. When you document thoroughly, you protect yourself automatically. Consider this carefully. If a fully digital IRS system reviewed your last year of financial activity, would the story make sense on paper? Would each large deposit have clear documentation? Would movements of funds align with your tax return? If yes, you're positioned exactly where you should be. If you're unsure, now is the time to organize records, scan documents, consult a professional if necessary, and clarify anything ambiguous. Preparation costs far less than penalties. You spent decades building your retirement savings. You planned carefully so you could enjoy peace of mind. The last thing you want is a preventable $10,000 penalty caused by misunderstanding bank reporting rules. The regulations haven't drastically changed. What has changed is the speed, visibility, and automation of enforcement. Retirees who thrive aren't those who panic. They're the ones who adapt. Deposit large sums properly. Never split transactions to avoid reporting. Maintain documentation for significant financial events. Ensure your tax filings reflect reality. View transparency as protection, not exposure. When your financial trail is clear, consistent, and organized, automated systems have no reason to question it. And that's where real peace of mind lives.